There has recently been an unusually large number of corporates opting for share buybacks over other uses for spare cash on the balance sheet. What are they precisely, and why would a company opt for a share buyback rather than use the cash to expand or reward investors directly with dividends? Let's get down to the basics now with income fund manager James Harries, who manages the Trojan Global Income Fund at Troy Asset Management. James, welcome.
Thank you.
First of all, precisely what are they? Explain it in words of one syllable.
Well, it's simply when a company buys back its own stock. And it can either then cancel those shares, so the share count overall reduces, or in Asia sometimes, funny enough, they don't cancel them, so it doesn't. But generally speaking, it's a company reducing its share count by buying back its own shares.
So are they good then for investors in companies that opt for this particular way forward?
Well, like most things in investment, it depends. What it really depends on is the valuation of the shares which the company are buying. Now, you alluded to the fact that companies can do a number of things with their capital at the end of the year, so to speak. They can decide either to buy other companies, they can pay down some debt, they can invest in their business, or they can buy back their shares. If they buy them back at a good valuation, then that tends to be a sound capital allocation decision. If, however, they buy them back when the valuation of those shares is elevated, well, it becomes rather more questionable.
Why is there an uptick at the moment? I can quote here from some research. In the first quarter of this year, US companies spent a record $178 billion in share buybacks. And that interestingly beat the last record that we saw, $172 billion, which is in the third quarter of 2007. Ominously, maybe. Why is there this uptick at the moment? What is it about where we are in the cycle that gives investors or companies the reason to do this?
Well, as an income manager, I view this as slight exasperation in the sense that share buybacks or companies buying back their own shares tend to be done pro-cyclically. Oddly enough, companies tend to buy more shares towards the top of the market than they do at the bottom. Now, of course, that's completely back to front. A much more sounder capital allocation framework would be to buy the shares when they're less expensive and not when markets are rather more elevated. Unfortunately, because of the dynamic that when you buy back your own shares, you increase earnings per share, it can benefit both the management of that company and it can flatter the earnings profile of the company. Plus, just simply the fact that people feel rather more optimistic and borrowing tends to be rather easier to come by at market peaks. So I think the fact we're seeing so much of it is an element of this pro-cyclicality coming through. We've seen historically and we're seeing again in this cycle.
Anything to do with the Trump tax cuts? I mean, we're talking there about a lot of US companies particularly doing this, and we heard a lot of US companies benefiting from the recent policies of Donald Trump.
At the margin, perhaps. I mean, there is a benefit in the short term, at least, from the tax cuts that President Trump's put through. As a long-term investor, they're not that important. But I think we have to remember also these share buybacks have been going on for quite a long time. It's not just a recent phenomena. So the uptick may be related to that, but the phenomena of large share buybacks being done consistently but pro-cyclically is a feature of markets, it would seem, particularly the US market. You're
an income fund manager. What are you thinking about share buybacks at the moment? Are you happy with them at this part of the cycle? Are you happy with companies that do that, or are you looking badly on companies that opt for this option?
Well, as I mentioned, we would generally prefer dividends. A company that declares a dividend is telling you quite a lot about what they think the prospects of the business are. They tend to be a sort of sign of confidence. Secondly, they don't get switched on and turned off at will. So that's another thing that you can sort of hang your hat on, so to speak. I don't think we can say with a broad brush that we think it's favourable or unfavourable. You have to look at each individual business and see what their capital allocation decisions are. But I did allude to the fact that it tends to be, over time, that companies tend to buy more shares back towards the top than the bottom, and that's a poor thing. So as a fund manager generally, but particularly an income fund manager, we wouldn't look particularly favourably on the capital allocation decisions being taken right now.
Yeah. What's going on in the Trojan Global Income Fund at the moment? What are you buying? What are you selling? What are you looking at?
Yeah, so we're trying to build a portfolio of high quality, financially productive, by that I mean high return on capital employed businesses to generate growth in income and capital through time. We worry at a degree, we have quite a cautious view on markets, we worry to a degree that the authorities in the form of the central banks and so on, by trying to generate a modicum of growth and inflation in the real economy, have created anything but something moderate in the financial economy. And we worry therefore that in aggregate, that equity prices are fairly elevated, that credit spreads are fairly compressed, and that risk appetites are pretty strong at the moment. And that's reflected in broad valuation measures, which are largely unattractive. It says very little about what the market's going to do in the short term, but elevated valuations tend to lead to lower returns. There's a fairly well-established relationship between the two. So we are concentrating the portfolio in what we believe to be fairly robust and defensive businesses at the moment. We're predominantly invested in sectors such as healthcare and consumer staples. We're also somewhat concerned about emerging markets specifically. We think in some respects this whole market cycle has been about a reach for yield, about investors investing for income and therefore bidding up the price of assets, both equity and debt, that generate an income. And I think a large part of that, or a particularly egregious example of that, has been emerging market debt markets and funds. If there's a problem in emerging market debt markets, we're likely to get into a problem in emerging market equity and FX markets, foreign exchange markets, which we think will be a problem for emerging markets, but also put upward pressure on the dollar. And indeed, today we're seeing just that. So we're concentrating in developed markets, we're concentrated in US dollar denominated assets, and we wait for an opportunity to globalize the portfolio as the problems I've just described, we fear, unfold.
Okay, well, it's a pleasure to talk to you. Thanks indeed,
Thanks very much indeed
for dropping by. That's James Harries, who manages the Trojan Global Income Fund at Troy Asset Management. Subscribe to IG for educational content, company insight, financial analysis and expert commentary.